Well, good afternoon, everyone, and thank you for joining today's webinar produced by Interactive Brokers and brought to you by Quantopian. I do want to introduce Paige Murphy with Quantopian, who's going to be giving us a brief intro to Max. So over to you, Paige.
Hi, thank you, Cynthia. Thank you, everyone, for joining on behalf of Quantopian. Today's webinar is called Factor Modeling, and our speaker is Quantopian's data science lead, Max Margenot. Max's background is in applied mathematics, statistics, and quantitative finance. He runs the online lecture series at Quantopian and is responsible for workshop curriculums and educational content. In addition to having experimented with algorithmic trading of cryptocurrencies and Bayesian estimation of covariance matrices, Max has also published work in theoretical mathematics. He works with top universities, including Columbia, the University of Chicago, and Cornell, and he holds a master's degree in mathematical finance from Boston University. Thanks, Max.
Thanks for the intro, Paige, and thanks, Cynthia, for hosting. I hope that everyone can see my screen right now. I'm going to assume yes. Let's go forward from there. Perfect. So yeah, hi, everyone. This is my talk on factor modeling. Normally, I have a much more exciting title like Buying Happiness or Thrifting Alpha, but I promise that this is still at least a little bit interesting. Just stay and just hang out and listen. So this talk today is about factor modeling, as you might have guessed. I'm going to be defining a lot of stuff, like there's a lot of talk about factor modeling in the space right now. And I just want to be totally clear on everything that we're working with. I want to talk a little bit about risk factors, a little bit about alpha and really what alpha means, and kind of get to the bottom of all of this stuff and summarize some of the main uses for factor modeling whenever you're working with an ordinary quantitative workflow. First off, this is a disclaimer. None of this is investment advice. And then second off, Paige already give a pretty good background of me. So this topic, factor modeling, cross-sectional equity modeling, is like a big concern for us here at Quantopian. Our whole shtick is that we have a online research platform where people all around the world develop algorithmic trading strategies that they then enter into our algorithmic trading contests, where they can win some cash prizes and basically go through the practice of researching and developing alpha signals and just testing them in some market or another against other competitors. So that's like one of the main things that we do here. And where I come in specifically is that it's very difficult to develop an algorithmic trading strategy or a quantitative trading strategy. And our goal is to guide somewhere around 200,000 people to put together these signals and implement them in algorithms and get it all going. So a lot of what I do is filling in the gaps there. So I develop a lot of educational stuff in statistics and finance and mathematics to fill in the holes for an engineer who wants to learn more about finance, or a finance professional who wants to learn more about software engineering or algorithm development. So this is kind of where it all comes together for us. So that's like kind of my background, the company background all together. So let's actually get into it. What is a factor? Right, I'm talking about factor modeling, so let's start with the first definition that we want, a factor. And I'm going to define it as some value that is assigned to some security in the universe. And this can be any value. Ideally, it is some value that is in fact related to that factor. And I'm going to get a little bit more into what that means, how we develop factors, how we research factors, how we want to think about them as we go throughout the talk. And generally, these factors are going to come in two separate flavors, alpha and risk. And I'm going to be circling back to alpha and risk in a little bit more depth later in the talk. Mainly, I want to define alpha and I want to define risk and make sure that we're all totally clear on what it means to really look for alpha or hunt for alpha, because it's this ephemeral thing that people talk about in quantitative finance all the time, right? Oh, so yeah, I trade alpha, I have these alpha strategies, but it's not really clear just from hearing it what that means. So that's one of my main goals here, to make that more clear, make it easier to understand what's going on, because alpha really only makes sense in the context of risk. Risk risk factors we think of in terms of like risk factor modeling. So you see that in a lot of industry risk models. That'll be stuff like BARA or Axioma. They'll provide a number of risk factors that allow us to do a bunch of interesting things with our portfolio returns. Namely, we can decompose risk into the constituent parts that pop up in the market at large, right? You have the base volatility measure of some return stream or another, which is what you traditionally use as risk, but that's not really a granular enough view, which is why a lot of these risk factor models have popped up and why these are such a hot commodity in general. They give us a lot more clarity than just looking at the standard deviation of a return stream. So next up, factor models are super popular, right? You may have heard of smart beta or smart beta portfolios or smart beta ETFs. They're kind of all the rage right now. We've had like this massive influx of ETFs in the market that your average everyday investor can trade. And this is all related here. Like a smart beta portfolio is just a factor model implemented in a portfolio. And part of what I'm going to be talking about today is how to construct that portfolio, how to put together that return stream. And here's some stats. So according to this Rise of Factor Investing set of stats from BlackRock, which is published in 2017, around 87% of institutional investors are incorporating factors into their investment process. And that's super general and non-specific, but 87% is a pretty big number, right? Only 13% of people are left out of the party, which is pretty good as far as parties go. 67% are incorporating these factors into their risk management process. So that's more looking at the risk factor models that I briefly mentioned, and then 53% are incorporating them into investment strategies. And this is stuff as of like a year and a half ago, so likely that's either increased or decreased, I'm not really sure. This is the last data point that I have. So what is the goal of having a factor model, right? I've talked a little bit about alpha, I've talked a little bit about risk, and I've talked a little bit about people generally handling these in some way or another. But whenever we think about returns, no matter where our returns are coming from, they're in some way associated with risk, right? That's kind of a basic tenet of modern portfolio theory, that in order to get a return, you need to come up with some sort of risk, or you need to take on some sort of risk. And when we think about alpha investing, whatever alpha is, that means that there is some specific risk that comes with investing in a particular alpha, right? And ideally, whenever we think about alpha, we're thinking about an uncorrelated return stream. Alpha is generally meant as something novel or interesting or new, right? So it's an easy way to diversify an existing portfolio. Because whenever you're thinking in the context of modern portfolio theory and diversification, right, what you want to do is add uncorrelated assets into your optimization process. Because if we add correlated assets, you're basically just making the same bet over and over again. And that kind of defeats the whole point of portfolio diversification, which is to lower the overall risk of the portfolio without taking too much of a hit to our returns. So that's what this alpha investing really gets at, right? If we can construct an alpha portfolio that gets at some specific risk premium, then we can diversify our pre-existing portfolio with that new novel return stream. We can also analyze risk, right? This is what I mentioned when I say we can break down the standard deviation of a return stream in terms of some constituent components. So this can be stuff like the CAPM or the Fama-French factors or any number of alternative factors, which I'll again get into a little bit later. But we can break down the sample standard deviation in terms of where it's coming from. And then we can use that to appropriately select new assets or appropriately balance between different strategies that we're trying to invest in. And finally, we can increase returns is kind of the final goal of factor modeling, right? That's a main goal in finance, in quantitative finance. All this quant stuff is ideally to both lower our overall risk and increase returns in an intelligent quantitative process. And that's kind of what we get with a more alpha investing perspective, and understanding where our risk comes from altogether kind of feeds into increasing returns. So there's a few different sets of portfolios that people typically construct whenever they're creating a common factor portfolio or a factor portfolio. And most factors are going to fall into one of 5 separate categories. And these mimic typical investment styles, right? There's value investing and a value factor. And this is a factor that tries to get at and identify undervalued and overvalued stocks. So you go short on the overvalued stocks and long on the undervalued stocks, ideally capturing this essence of value. There's momentum, which is the idea that a security that has been doing well in the past will continue to do well. Things that have been doing poorly will continue to do poorly. And there's any number of ways that we can actually quantify momentum and value in all of these individual factors. So there's no like correct way to do it, but there's a few common sense basic ways that people go about doing this generally if we're instead quantifying these as risk factors or something like that. But momentum gets at this idea that things continue along the path that they have been on. Quality tries to get at a lot of more fundamental based stocks, or a lot of fundamental based statistics, trying to find and identify securities that are high quality or low quality and going long and short on those respectively. Volatility is a little bit weirder. This tries to get at the essence of volatility, and whether we're investing in a low volatility factor or a high volatility factor kind of depends on the market regime or our particular risk constraints. That really depends on what you're trying to do, but trying to get at that essence of volatility. Then there's this notion of growth, which is trying to go long on securities that are high growth and short on securities that are low growth. So most factors that you'll see, a lot of alternative factors that you'll come up with, are going to fall into one of these 5 categories. And we can kind of come up with this characteristic essential portfolio for each of these if you really want to. For actual portfolio construction, how we actually use a factor, we use this method called cross-sectional equity, or you may know it as long-short equity. The idea is that you rank all the securities in a universe that you have selected from the lowest factor value to the highest factor value. You then go long on the top percentile of securities, and you go short on the bottom percentile of securities. And what you're doing is you're essentially making a bet on how effective your ranking scheme is. The better your alpha factor, the better your ability to kind of segregate the good securities from the bad securities according to your factor. What we're kind of implicitly doing is saying that the value of my factor is proportional to the expected return of the assets in the baskets, right? If I'm breaking up into different quantiles, typically you use like 5 quantiles, then you would go long on those that have the highest 20%, the 20% that have the highest exposure, and short on the stuff that has the lowest exposure, that bottom 20%. And ideally, we're going to have a very high positive return in that top basket and a very low negative return in that short basket. And this allows us to keep a lot of positions and a lot of securities at once. We kind of have this self-hedged portfolio, because if you're holding a lot of stuff long and a lot of stuff short, unless your factor is specifically the market itself, you're going to be relatively market neutral and neutral to a lot of other risk factors. And it's just generally a good way to go about constructing a portfolio. And this is how these ETFs are constructed. This is how all like factor return streams are constructed, by trying to take long positions in the highest positive exposures to our factor and trying to take short positions in the lowest negative exposures to our factor. This gives us just a full exposure to the one factor that we are looking at. And we can use this to either get at alpha or get at risk. And this is what like a toy example of this would look like, right? What I've done here is I made a bunch of random factor returns. This is all just toy statistics to make a pretty picture. But the idea is that as our factor value increases, we're going to be in a higher valued basket, and we're going to have a higher return associated with stuff. So this top basket here is what we're going to go long on, and this bottom basket here is what we're going to go short on. And as long as the spread between these baskets is consistent throughout time, then we're going to be making a decent return, whether the whole market is moving up or the whole market is moving down. Because as long as the top basket outperforms the bottom basket and continues to outperform it, we're going to make some sort of return. So I've mentioned the universe a couple of times. We need to rank our universe according to our factor. We need to make sure that this universe has sufficient liquidity, right? What we want to do is place hundreds of bets long and hundreds of bets short all at the same time, which means that we need to be taking up positions in things that we can actually trade, right? Because if we have an algorithm or any trading strategy really that is trying to place these orders in the market and none of those markets are actually getting fulfilled, then you're going to be in trouble, right? You're not going to actually execute on any of the positions that you want, and your strategy is just kind of going to fall apart. If you have any sort of high quality performance without any actual positions being entered into, or very few positions actually being entered into, then you're at a very high risk of everything breaking down, right? If you're not being able to place orders, then odds are you're only invested in a few names here or there. And if those names outperform or underperform, you're exposed to that. So you're kind of counteracting this portfolio diversification if you're not trading a sufficiently liquid universe. And this includes stuff that is just hard to trade, right? So that's security, that's penny stocks, any weirder sort of securities that trade on the market itself. We want to exclude all those from our universe and just get a bunch of very high quality assets that we can actually trade. This is a bit of a pain because in quant investing, a lot of what you're doing is trying to find inefficiencies in the market. And in a lot of cases, it's these illiquid securities, these hard to trade securities that have a lot of inefficiencies in how they're priced and how they trade. But we can't actually get at them because of the physical structure of the market. It's a bit of a shame, but it's worth taking into account whenever you're constructing this universe, unless you're going for something that is specifically going for these low capacity, inefficiency-based strategies. If you're working on the Quantopian platform, we have this Q-Tradable Stocks US, which is this sufficiently liquid universe that we generally use in all of our algorithms and generally have our community use. And this includes filtering out these penny stocks, filtering out a lot of this hard to trade stuff, and you can just import it and use it in our back tester or in our research environment pretty easily. So here's an example factor, and we'll call this an alpha factor without loss of generality, just so that we have something that we're working with, right? This is how you would define momentum using our pipeline API. We have this momentum factor, which takes in close prices and returns, well, 6-month returns, over the past year. What it does is it takes the past month's worth of returns, the past year's worth of returns up until the last month, subtracts out the last month's worth of returns, and then standardizes by the volatility of the returns. And this is calculated for every single individual asset in our Q-Tradable Stocks US. If we want to trade this as a factor portfolio, what we then do is we break it into quantiles and have a look at what the baskets look like, right? So this is breaking that momentum factor calculated over 2015 into 5 quantiles over 1, 5, and 10-day horizons. So this what this essentially comes out to is like 1 day, 1 week, and 2-week rebalancing schedules for the defined momentum factor. And these are what the mean returns of each of those individual baskets for each of those individual time horizons looks like. It looks like this 10-day horizon has the highest spread between everything. So going forward, what we would do is we'd use this 10-day and try to rebalance every week, try to construct our portfolio like that. And I put together this plot using a tool called AlphaLens. I've got a link towards that at the end. It's an open source signal analytics library that we use to evaluate the predictive power of factors and see if our hypothesis that there is value associated with this factor actually pans out. This is what each individual quantile looks like in cumulative return. And it gets a little dodgy at this beginning part here up until around June, but then it spreads out about as we would expect. This top quantile is the highest, this bottom quantile is the lowest, and then these guys in between are all just noise. We're throwing them away because we only really care about the extremes. That's where like the really interesting stuff is happening, right? In the tails of this distribution. And this is what, without slippage or commissions, this signal would perform, ideally balancing on a 2-week timescale. And that looks pretty good. If you actually implement this with slippage and commissions, it looks a little worse. But this is just a toy example meant to kind of illustrate how we would put together this factor portfolio, right? We have our factor defined. We have the number that we compute on every single individual security in our universe. We then split it up into different quantiles, and we go long on this top quantile and short on this bottom quantile, yielding this return stream. And we can do with this return stream what we will. So why would we actually use this method in the first place, right? It's a little unclear why we would go through this whole process of computing factors, ranking on this universe. And the basic idea that we're trying to get at is that predicting prices is hard. Like, it's really hard. We have a bunch of super complicated models for trying to predict prices. But really, unless you can see the future, you can't reliably know exactly what a price is going to be later. So we're getting around this by doing something different. We're not trying to predict prices. We're instead trying to capture this relative value of the long and short baskets. And again, this key implied assumption is that the expected return of each security is proportional to the factor value. As long as these baskets spread apart from each other, we're going to make some sort of return as constructed. And that's a lot more convenient than trying to directly predict a price, right? This is a lot easier to put together. It's easier to figure out where to start. Like, as long as I have some value associated with my securities, then I can rank them and test to see if it actually works. That's a lot quicker than waiting for tomorrow and trying to figure out if your crystal ball actually is worth anything, or if you need to return it to the pawn shop where you bought it. So what I've kind of been alluding to is this quantitative workflow, how we actually want to think about this process of taking data to a universe, to factors, and kind of piecing it all together into a portfolio. We start with some set of data. This can be pricing information, this can be fundamentals information, this can be any sort of alternative data that you may be using. That's something that I didn't really mention before. This factor value can be based on anything, right? Which means it can be based on some weird, cool data set that you just found in the wild, right? And you think it has some sort of bearing, some sort of predictive power in relation to securities. This can be stuff like 10K reports if you want to parse, like using natural language processing, any sort of communications from a given company, and determine anything about the management, determine anything about the company. You can take a common example is geospatial data to look at parking lots of a lot of retail companies. You can take sentiment data from Twitter or Facebook or any other sorts of social media. You can use all these sorts of alternative data sources in order to come up with some factor. This is just like a hypothesis, right? I suspect that if I use this data set, I'll be able to come up with some model that allows me to predict the long and short baskets that I would want. It allows me to get this ranking scheme and ideally get a sense of the expected return of these assets. These are all different data sources that you can use in this workflow. And they all kind of feed into how we want to define the universe and how we want to define the hypothesis. So this fundamentals and this pricing information and whatever alternative data sets you have feed into your definition of the universe. And this universe can be catered to an individual alpha factor. Really, the only requirement here is that it's sufficiently liquid and interesting enough that your hypothesis will actually pan out, right? Constructing this universe is a super important part, almost as important as constructing your hypothesis. Because in a lot of cases, the hypothesis needs to be in some ways catered to the universe, right? If you're using a long-term alpha factor or a long-term factor, you want to have a universe that is appropriately matched to that. You want to be looking at time horizons that are appropriately matched. Make sure that everything is kind of matching, right? And then from this universe definition, you'll construct any number of individual alpha factors. This can be any of the momentum, quality, value, that kind of stuff that I mentioned, or some of these sentiment factors, all this stuff. And we combine it into one big alpha factor and feed it into our portfolio construction, which will include some risk models, some objective function for how we want to actually allocate amongst the securities that are selected. And eventually this leads to execution. Then we do it all again the next day or whenever our next rebalancing period is. So this is just a general framework for how we want to think about developing quantitative strategies and developing hypotheses and iterating on them to quickly come up with portfolios and quantitative portfolios. So let's talk about alpha and risk, right? We see in this that we have this alpha combination here over on the left-hand side, and we have this risk model. So how do these really relate to each other, right? And constructing either return stream, an alpha return stream or a risk return stream, is going to be in line with the typical form that I've laid out before for constructing any real factor portfolio. But how do we actually distinguish between alpha and risk, right? How do we make this clear? When we think about portfolio diversification, we're investing in many, many different independent assets all at the same time. And these company level risks, these idiosyncratic risks associated with individual companies all disappear. So if one name blows up, ideally you're holding 300 other names, so you don't really need to stress about any one individual thing. You don't have too much of a position concentration allocated to that name that did poorly because you are appropriately diversified. But kind of a side effect of this, and something that you can't really get away from, is that a lot of common factors remain in your portfolio. A lot of common factor risks still exist here. You've gotten rid of all the stuff that has to do with individual companies, but now you're dealing with the market. You're dealing with individual sectors. You're dealing with various different investment styles that you may run into, right? These are these larger common factors. And we can define these common factors however we like. And this is kind of the key to how we define alpha. Depending on how these common factors are defined, alpha is what is left over after we get rid of the influence of all those common risks. So it's super dependent on your investment mandate. It's super dependent on what you're trying to do. So momentum, some people might define as a alpha strategy, right? There are a lot of funds that are based entirely on just trading momentum strategies, but some other people may consider that to be a risk factor because it is such a common, well-known factor, right? So they're kind of two sides of the same coin, alpha and risk. So let's talk about some common risk factor models, starting with the capital asset pricing model, which uses the market at large as a single common risk factor. We take the return stream of our portfolio and we decompose it in terms of alpha, an intercept term, and beta to the market, which is the influence of the market itself. And here is kind of the dirty little secret of factor modeling. It's basically just rebranded linear regression and rebranded multiple linear regression. Statisticians knew about it for years, and then the CAPM came along and decided to redefine it as a factor model. But the important thing here is that we can directly quantify my return stream of my portfolio is broken down into the returns of the market and what's left over. So this beta gives me exactly how many units of return my portfolio moves by when the market moves in one direction or another. So make no mistake, you can make a lot of return from just betting with the market or betting against the market, if that's more your bag. But that means you have to deal with both the upturns and the downturns of that, right? If I have a high beta exposure, a high value here, a high positive value here, or a high negative exposure here, then if the market if the market moves in any significant way, then my portfolio is going to be taking a hit, either in the direction of the market or against the direction of the market. So it's important to quantify my portfolio and know how much of my returns are actually coming from the market or whatever other risk factors you want. If this beta is super close to zero, then you're relatively independent of the market itself. But this is a pretty simplistic model. This is pretty basic, right? So some extensions have been developed to this. There's the Fama French factors, which adds a couple additional common factors to the base capital asset pricing model, most notably high minus low and small minus big. And this is high book to price ratio minus low book to price ratio and small minus big, which is small market cap minus big market cap. And what this tries to get at is a little bit of growth and a little bit of the premium that you get for small market cap companies over large market cap companies. And we still keep in this market return here. So what we get is the influence of the market, HML, and SMB on our portfolio. And we get 3 separate individual beta exposures. This is great because now we know that alpha is what's left over after we subtract out these 3 guys, right? But knowing this influence and trying to be independent to these is important. Again, in the same way that trying to be independent to the market is important. Because again, if we have a lot of exposure to these common risk factors, we don't really have alpha. Now, this is our risk model. And we can extend this to as many individual factors as we want, to as many separate return streams that we want. In this kind of laid out multiple linear regression, we can have R0 is the market, R1 is small minus big, R2 is high minus low, but then we can add in sentiment, we can add individual sectors, we can add in whatever individual return streams that we want that we might be concerned about. And what this lets us do is we can break down our volatility in terms of these individual risk exposures. We can say I have N% of my volatility comes from momentum and M% of my volatility comes from value in general, right? And this lets me get a good sense of how my portfolio can be deconstructed in terms of all these various different factors. So the Quantopian risk model is broken down in terms of 11 individual sectors. So this is just one way that you can go about doing it. This is the way that we've put together our risk model. Instead of looking at the market at large, we look at the 11 sectors defined by Morningstar in the market. And that's like materials, consumer defensive, real estate, consumer cyclical, healthcare, and so on and so forth. And this lets us get a more granular view of each individual sector's influence on our portfolio. And this is important just because, well, if I have some strategy that I'm touting as a technology sector strategy, then if I run it through our risk model and I don't get any technology exposure and it turns out that it's all momentum and industrials, then I should be super worried, right? I've designed it as a technology strategy, but the actual performance attribution of this strategy has nothing to do with technology. This is a main use that we use for risk models, right? We don't necessarily care that we have a high sector exposure to technology. What we care about is that we have sector exposures that are not what we bargained for in the first place. Our strategy as implemented is not in line with the hypothesis as put together at the outset. And this is kind of this a key part of performance attribution. Because if we know exactly where each individual strategy is coming from according to our risk model, then we can combine things that may be high risk in one sector and low risk in other sectors with stuff that complements it. So we can appropriately balance our risk amongst many different individual strategies on both the long and short sides of the book. So risk isn't necessarily a bad thing, but knowing about risk is absolutely critical to intelligent investing. And then we also have these 5 sectors as part of our risk model. And this is momentum, value, short-term reversal, volatility, and like a market cap factor. So we have 11 sectors and 5 individual styles, and these all kind of come together into one big common factor risk model. And what this lets us do is break stuff down, right? Here's our 11 sectors, and here's our 5 styles. And knowing these exposures lets us say, well, in my return stream, and you can do this with any risk model, including the capital asset pricing model, or just the Farmer French factors, or this risk model with Axioma, with Barra, with whatever you have. As long as you can implement it like this, then you can decompose your return stream like this. What this says is I have this total return stream in blue, and I can break it into the specific returns in green and the common returns in red. And the common returns are what come from these risk factors here and here. And then the specific returns are the alpha, or the returns due to alpha. That's what's left over. Having a high specific return and a high common return shows that I really have an alpha strategy. You can actually confirm that my strategy is what I'm looking for. It's this new uncorrelated return stream. I can add it in and get all the benefits of better diversification and increasing my return and proper awareness of where all my risks are coming from by incorporating this sort of thing into my portfolio. So alpha is what remains after you have removed all common factor risk, kind of just to summarize, right? And this can be a 16-factor risk model with 11 sectors and 5 styles, or this can be just the capital asset pricing model. Maybe it can be the capital asset pricing model with some sentiment exposure in there as well. Whatever you want. Your alpha is what is left over after you have removed all of the common factor risk. And it can only be defined in terms of what you don't want, right? I've been very careful to say that alpha is what is left over after I get rid of the common factor returns. And that is going to be consistent across all investment mandates. The alpha is what is left over. So if we actually want to find alpha, this is super hard, right? You can get a lot of return from common factor risk. And a lot of people do get a lot of return from common factor risk. But it just depends on what you're considering a common factor and what you're considering an alpha factor, right? A lot of times strategies will perform well because they have a high exposure to something. But it's not just the returns that are important here. It's your awareness of where those returns are coming from. So if you have a lot of returns coming from the market and you don't want exposure to the market, then you kind of have to go back to the drawing board and find some other source of alpha that is actually alpha. So it's this very difficult problem. And to find a reliable source of alpha, you have to have this clearly defined set of common factor risks from the outset. You need to know what you don't want from the beginning so that you're appropriately designing strategies to be aware of sectors or aware of styles or aware of whatever individual components you may be worried about in your investment mandate. And then alpha decays, right? We look for something, we find something, and it works, and it's great, and it's got a lot of alpha. It doesn't have any of these common factor risks that we've defined, but strategies kind of stop working after a while, right? This is what you see in finance a lot of times. A lot of papers that are published are strategies that used to work like 10, 20, 30 years ago. A common thread that I get whenever I read any sort of factor portfolios or any sort of papers on factor modeling is that, well, okay, yeah, there are these factors that work in less efficient markets like Asian markets or like European markets, and then you have to do something completely different for US markets just because they are so efficient. And there are so many people looking for these inefficiencies and looking for alpha that it makes it harder and harder to hold on to this stuff for a long period of time. So you need to have this constant search for more strategies, for more alpha factors so that you can keep your portfolio running and ideally keep getting all the benefits of having a well-diversified factor portfolio. That's kind of like the grand summary, and it's a little bit of a bummer, but that's kind of what we're used to, right? If you want to find something good, you need to be constantly diligent. You need to be constantly looking for a new strategy, some new hypothesis, so that you can keep your edge, keep this information advantage that you have, and keep your models as the best. For the tools that I used in throwing this together, AlphaLens is what we use for evaluating the predictive power of factors. That's available on our GitHub, and it's also integrated into our research environment. You can use Pipefolio for portfolio analytics. That's what I use to generate these risk factor decompositions from the stuff before. That's these guys. Pipefolio is what kind of breaks down stuff into sectors and into individual styles. Then this zipline library is where I define my pipeline factors and how I efficiently define factors and factors across universes and how I actually filter down my universe. It lets me get individual factors for every single security in my universe every single day. For references, a lot of these graphics are taken from the Quantopian lecture series, which is the educational stuff that I run, and that's at quantopian.com/lectures. And in particular, if you're looking for factor modeling, there are at least 3 lectures specifically on this topic. I know there are more, but I felt like I'd pull out these ones in particular. This is a capital asset pricing model and arbitrage pricing theory, and that looks a little bit at the root development of the CAPM and of arbitrage pricing theory, this notion that we can decompose a return stream into individual factors. There's factor analysis with AlphaLens, which is a lecture on analyzing individual factors and their predictive power using the AlphaLens tool. And then there's this risk-constrained portfolio optimization lecture, which is about using a risk factor model in a portfolio optimization routine. So that instead of just taking a mean variance portfolio where you're minimizing your risk and maximizing your returns, you're minimizing your exposure to individual risk factors and trying to maximize your returns in conjunction with that. And then we have a paper on the risk model. If you're looking for any sort of risk modeling papers, there's like the Axioma handbook and the Barra handbook and all the stuff that they put together. There's also our risk model, which is on our website at quantopian.com/papers/risk. If you're interested in checking out stuff that I do, my Twitter is Clean Utensils. I don't really tweet, is what I usually say, but I've been tweeting surprisingly often in the past week or so. So my typical bit here doesn't really pan out. I promise I'll go back to not tweeting super soon, probably immediately after you follow me if you decide to or not. But that's where you can find some of the stuff that I talk about. More of the stuff that I talk about is on my GitHub, which is actually where these slides are hosted. So if you want to go have a look at these slides with the notebook that generated them, that URL right there is accessible to whoever wants to go and check it out. And then if you just go to my base GitHub, that's got like all my other projects. If you have any questions, you can email me at max@quantopian.com. And then you can actually enter our daily contest at quantopian.com/contest. This is our cross-sectional equity modeling contest, and a lot of the stuff that I talked about today is involved in developing a strategy for that contest, namely trading within a liquid enough universe, keeping a well-diversified portfolio, and having a well-defined alpha factor despite all sorts of common risks. And last but not least, a disclaimer. None of this was any sort of investment advice. This is just an interesting topic in finance that I felt that I want you to know about. Now it's time to talk about some questions.
And while Max is taking a look at the questions, I want to remind everyone on the right-hand side of your screen, you'll find a questions panel where you can submit any of your questions for Max at this point. Thanks. Back to you, Max.
Thanks, Cynthia. So the first question is, if you have multiple alpha factors with optimal alpha at different holding and rebalancing periods, is it possible to combine them in the same strategy? So it depends on how you view a strategy, right? Because if you have a bunch of different alpha portfolios, that's essentially the same as having a bunch of different individual alpha-based assets, right? So there's like that meta strategy where you're rebalancing each of the individual portfolios at different time horizons, and that can be considered a strategy by itself. Like definitely if you have something that is best rebalanced every 10 days and something else where after one day it completely decays, you want to be trading those on different time horizons. So it really depends on how you're trading strategies. Like you can add some stuff like some individual flags into your algo implementation or into how you actually go about trading that says, okay, well, trade this one every 1 day and this one every 10 days. But generally, you'd probably want to look at this at sort of that meta level where we're only touching the orders of this one every 1 day and the orders of this other one every 10 days. Like trying to match up the rebalancing period for each individual alpha factor to the speed. What is the factor exposure on the vertical axis? So I assume you mean in the plots that I put together. So that's just literally the beta exposure to these return streams. That's like essentially the same as my market beta exposure to the market, just my beta exposure to an individual sector or an individual style. What return frequency should we look at to find alpha, monthly, quarterly, or yearly? There is alpha at every single individual time horizon. It really is entirely based on the hypothesis that you are putting together and how you think that strategy is going to pan out. So if I'm thinking in terms of like momentum strategy, I might think of that as something slower, right? I might want to rebalance that far less frequently than something that takes into account a lot of intraday data and needs to trade every hour or every minute, that sort of thing. Can Quantopian backtest option strategies? Currently, no. Not on the platform itself. We only have US equity data right now, and we're in the process of adding international equities, starting with Canada. Zipline is an open source library though, so if you want to backtest option strategies, then you can fork Zipline and try to add that yourself, that kind of thing. It's not currently in our product roadmap. Any sector factor risk mean reversion strategy return? I'm not really sure what this question is asking, but I'll take a stab at it. Yes, I assume that you can put together a strategy that looks at mean reversion with each individual sector. I don't see why not. There's probably some different way to define mean reversion that works in each individual sector. And it's just a matter of getting those together, building up the alpha portfolios and testing them, seeing if that hypothesis actually pans out. So how can you measure alpha decay? So kind of what this comes down to is, hey, I have this strategy, and if I rebalance it at one particular period, how does the return change if I rebalance it at t plus 1, t plus 2, t plus 3, and so on and so forth? What you want to do is look at the returns or the information coefficient across, or the information ratio across many different time horizons, and see kind of that curve as it kind of falls apart, right? Let's say I rebalance, or I calculate the values of like rebalancing for like 1 to 30 days. If it's like a super fast strategy, if it has a pretty high alpha decay, then you're going to want to be rebalancing like every couple days. And ideally, well, I guess not ideally, but as a strategy gets more and more mined out, that curve is kind of gonna get tighter and tighter until you just don't get any return from it. So kind of just the change in that curve of returns over this alpha horizon. Are factor modeling a more common used investment strategy than fundamental analysis? So factor modeling is a form of fundamentals analysis, right? I can define high minus low and small minus big, and I guess not the return to the market itself, but high minus low and small minus big, and a lot of these basic risk factors in terms of entirely fundamental factors. Like it's all broken down in terms of classic stuff. Fama French has been around for a while, and people have been using it for a while. So yeah, it's a pretty common way to break stuff down, right? Like if you're talking about my beta exposure or my exposure to high minus low or small minus big, then you're talking about a factor risk model. Do we allow users to use models and recommendations for fees? Yeah, so if you're simulating stuff in the back test here, you can define your own slippage and commissions models. So if you have your own concerns, your own way to define slippage and commissions, then you can just redefine that for any individual backtest or any set of backtests that you want. Does IB give enough data to discover more alphas? Do we want fundamentals that are old enough? I mean, really, you don't need stuff that goes back particularly far, right? Even like a few years worth of data is going to be enough to try to come up with a new hypothesis and try to test it out. Really, you don't really know whether something's going to outperform or do super well until you've like started paper trading it and eventually put actual money on it. We only have data back until 2002, and that's still pretty solid for finding individual alpha strategies. So like this time length of data isn't super concerning. If you want to play with a pipeline model, what's the procedure? So we have a tutorial on pipeline at quantopian.com/tutorials. And you can just go to that. There's this pipeline tutorial here, which talks about how you actually use pipeline and put everything together. And we also just put together a short video on pipeline that I think is coming out tomorrow, but it's worth checking out. And failing that, you can always just read through the code on the zipline library on our GitHub. Let's see. How do you optimize portfolio weights? I mean, that's a super general question, right? There's a bunch of different ways that you can optimize portfolio weights. There's like the classic mean variance portfolio. If you haven't read that paper, it's worth checking out. And that's just let me maximize returns subject to minimizing volatility and the correlation between everything. And that's one way to get optimal weights. You can also just try to equal weight everything and say like, hey, I have some target set of weights and I have these other constraints that I want to add into the mix and use some convex optimizer to piece it together. And if you want an idea of how to use risk factors in an optimization routine, then check out that risk constrained portfolio optimization lecture that I link on this slide here. This one right here should give you a good primer on how to incorporate these risk factors into it. Considering factor rotation strategies and meter version of the same, are there tools that Quantopian has developed to gauge relative effectiveness of the library of alphas over a given period? That's what Alpha Lens is all about, trying to evaluate the predictive power of factors for a set of time horizons over some set of time. So if you're looking for that in particular, check out using Alpha Lens to evaluate the predictive power of any of these. High max is smart beta similar to alpha. Yeah, basically what it means is that they're just defining their beta exposure as an alpha. Like if I have some smart beta ETF that tries to track value, then that means that value is the alpha associated with that ETF. So it's basically just two sides of the same coin, right? Would factor modeling approach be appropriate in the black swan or disruptive scenario? Ideally, if you're super well diversified, you're going to be relatively immunized in terms of a black swan scenario, but this takes a lot of stress testing. This takes a lot of like simulating how it would actually perform, right? Factor modeling is just one way to construct a portfolio, and then you would use whatever ways that you would typically typically evaluate a portfolio in a black swan strategy or a black swan scenario. Whatever ways you would typically use to evaluate a portfolio there still apply for factor modeling. You use the same stuff. If you have 500 factors to test, can you input the 500 factors and test them efficiently and automatically? I mean, you'd need to code up all the individual factors, and then I probably loop through all of them. So if that qualifies as automatically, then yes, it can be done automatically. Efficient 500 factors is a lot, and if you're computing 500 factors across a large universe of securities, that can be a lot of time, especially if you're doing analysis on each of these individually. Ideally, what you would do is pick out the ones that you think are best, and then put together some portfolio there and slowly add to that. But if you really wanted to, you could definitely test all 500 factors at once. I'm not sure I'd recommend it. Is there a library that takes the model and executes it within IBKR? I'm not sure. I assume that's something to do with interactive brokers, but I'm not really familiar with that product. That's probably something that you would want to ask your reps over at IB. Where do I retrieve my data stream from? How do I check whether it's credible enough to build a model on it? So we get our data from Morningstar, and I don't remember where the pricing data comes from, but we go through a lot of effort to make sure that it's actually good. Like, this is the same data that we use to trade in our fund, and a lot of engineering work goes into validating the data and making sure that the tools handle the data appropriately. As far as other data sources that I've pulled together, that's really just a matter of like I have some factors where I use like patent data or sentiment data. That kind of stuff is really up to you to validate if you're building a factor on it. And that includes going through appropriate testing procedures to see if the factor is actually predictive, and then again going through rigorous testing and back testing to make sure that in a simulation, when it's getting stuff in real time, it's actually using stuff appropriately and not just falling apart. So how do you compute exposures? The same way that as laid out in those linear regressions before, you just compute the linear regression, and that beta exposure is the exposure to any individual common risk factor. How much backtest data should you use? That's a super general question. If you're interested in entering into the contest, it has to be at least 2 years. But generally, backtests aren't super predictive of future returns. It's super easy to overfit a backtest and make a backtest look really good. So really, the only appropriate answer is as much as you need in order to be confident in it. And really, kind of that ultimate show of confidence is like either paper trading or actually putting money on it, that kind of thing. Are there any techniques to measure and isolate market-related noise, such as earnings surprises, sudden management shakeups, that sort of stuff in the portfolio? I mean, what you would do is you would construct a portfolio that is an event-based portfolio. You would try to compute a factor like that, and you'd compute exposures to that portfolio return stream. Once you've quantified your factor as exposed to earnings surprises or management shakeups, that kind of thing. With event strategies, it might be a little bit harder to get that signal, but if you can quantify it, then you can use it in this exact same way. Is the alpha reported by the Quantopian backtester computed by the AlphaLens code? No, so that's done using Pyfolio. AlphaLens is purely this analytical tool, so it leaves out slippage and commissions. Whereas with Pyfolio and the stuff in the backtester, that incorporates slippage and commissions. And AlphaLens currently does not have the risk model in it right now. You can format stuff for Pyfolio input, so you can compute the exposure of your risk factor to, or of your alpha factor to the various common risk factors in the Quantopian risk model. But that stuff is all done in Pyfolio, not in AlphaLens itself. And again, you can use Pyfolio offline. It's just the risk model is only available online. Is the max drawdown on portfolio also measured in backtest as a risk factor? Yeah, this is again like one of these sort of statistical measures, right? Ideally, like a good strategy doesn't have more than like a 20% drawdown, but it's reported in the backtest, so you can get that in Pyfolio, and I think it's relatively easy to compute anyway. What's the range or average alpha annually? The alpha of what? right? You need to define what your risk factors are so you can actually get your alpha. And then based on what the alpha of your strategy is, you can compute the value or the annualized alpha of your strategy. Like it still has to be done on an individual basis. Does machine learning have any utility in searching for and analyzing factors? Analyzing factors, I think you're better off just using like alpha lens or generally more conventional techniques. If you're putting together a factor, right, like a sentiment factor is based almost entirely in machine learning, right? You're going to be using like a neural network or, I mean, I hate to call a logarithmic regression a machine learning method, but there are some people who will say that. I wouldn't, but you can definitely use machine learning in order to put together an individual factor. And if you're working with any sort of unstructured data, using some supervised or unsupervised method to kind of break that down is going to be a good way of making sense of that. Like if you're working with text data, you're going to be using natural language processing and appropriately a bunch of machine learning methods in order to actually use stuff there. And I think I've got time for one more question. So let's look at, okay, so how would you identify the overfitting of a model? So that'll generally be like if you have this significant difference in sample and out of sample trading, right? So your back test you can consider in sample, like everything you've seen up until literally 12:56 p.m. on Wednesday, September 26th is considered in sample. And then starting tomorrow, you can start generating some out of sample data. So like you'd freeze your code in place, and then you start accumulating this out of sample stuff. And then you'd try to see if your in-sample performance correlates in some way with your out-of-sample performance, if there are any statistics in common between those two. A couple quick and dirty ways to see if your backtest itself is overfit is to just like change the start date. Just like change it to one day before or like one day after and see if it performs the same. Like if it's overfit to work only in a particular time range, that's one way to get it to pan out. In a book by Ernie Chan, which I think is Machine Learning for Quant Trading, I don't remember the proper title of it. He's got some interesting notions on how to handle data. And he talks about like just take the data in your time period and run it backwards through your model. And I thought that was like a super neat way to go about testing something, just robustness, right? Like given this set of circumstances in the market, it's moving in this particular direction. How does my strategy perform? How does it adapt to this new market regime? Because ideally your strategy adapts to, your strategy will work independent of the particular time period that it's working on. That's one way to make sure it just turn everything on its head. But kind of the quick and dirty way is going to be just change the start date, see if there are significant deviations in performance, and then start accumulating extra sample stuff. And that was my last question.
Okay, well, with that, what a terrific presentation, Max. Thank you so much. Awesome information. A good deal of thanks to Quantopian for making today's webinar possible, and thanks to all of you for joining us here this afternoon. By the way, you can also access other interactive broker presentations directly from our website. There's an education menu that includes a webinar section, and simply browse through the recorded archives and you'll find a wealth of information there. So with that, and I see we didn't have a chance to get to everyone's question here today, but we do appreciate your participation. So with that, we are going to conclude today's session. You can all exit using the X in the upper right-hand corner of your screen. Thanks all, and have a great rest of your day.